Good morning, and welcome to Market Wake Up. I am super excited to get in today. We've got a lot to get through. A lot has happened overnight. Not too much coming up, but we've got some fantastic trading ideas. And if you haven't seen the title already, we're going to talk about one of the best seasonal plays of 2024. So without further ado, let's get into it. Good morning, John. Just gone 8:30 a.m. British Standard Time. How you doing?
Yeah, I'm doing good, mate. How are you?
I'm well. I'm in the office today, as you can see. A little bit different in background, but I'm feeling good. I think yesterday's first show went off with a nice little hit. It felt smooth. It felt nice to be on the new channel, and it felt nice to add all the new branding. Musclay's popping in, Andrew's popping in. Guys, make sure if you are here and you want to be part of the content to use this chat box to your full potential. There's a reason we do this live, and it's so we can actually communicate with you guys as we run through our ideas and our analysis. But how's Spain treating you? I'm not seeing any sunburn. I'm not seeing any suntan. What's going
on? Oh, we're not getting it. Well, to be fair, yesterday it was a little bit cloudy. So we had a little walk around some markets and stuff like that yesterday and had a little go, although it was quite interesting because we went for a bit of lunch before. We were like, right, let's go have a bit of tapas, before we go and have a walk around the market. Yeah, gotta have the tapas. I think I'm living on patatas bravas while I'm here, so and basically just was like basically it was like, let's have a bit of lunch before we go out. We got out of lunch to the market and it was closing down, so we were like, what? It was only like 2 p.m. We were like, what the hell? So we had a little run around and managed to pick up some olives and stuff. And I'm obsessed with olives, so these olives that are like that big, and it was like, oh yeah, we're gonna have that with a bit of dinner. Had a little barbecue on the evening, so yeah, living it up at the moment. So yeah, I'm enjoying it.
That's good to hear.
I can live in Spain. I can live in Spain. Or the south of France. Either of those, I'd be happy to live in.
This guy.
Or, I've not been to Australia, so I can't comment on what Australia's like. And I think you're biased.
I am very biased. I think that should be known. I am very biased, but that's also because I have lived in the UK, so I've experienced both. So I'm allowed to be biased because I've done both. Yep. So but no, I agree. I'm glad you're having a good time. I'm glad I could drag you back into here to talk about depressing markets and what's going where. Today's been an interesting day. An interesting day because obviously we had the Chinese stimulus kick in. Stocks have rallied in China from that. Mainland stocks in particular, they're up like 5%, the indice, which is really, really interesting to me. Look, I haven't done a lot of diving into figure out what investors are seeing as positive here. My first instinct goes back to the analysis we did 3 months ago, was when we discussed the floor. Right. And that floor that the Chinese government was saying, hey, in and around this level, we're going to get involved. We're not going below this. That's the floor. And I think a lot of investors are jumping on until we figure out where that floor is. They're like, hey, let's get involved because we know the Chinese government's going to step in and we're going to have some fun with it. And I think that's what's happening, but I can't say that is what's happening. Did also cause gold to see a little bit of strength, which was an interesting one. But do you have a take on this, or do you just not care at all?
That's a good question. I don't necessarily have a take right now, and I would care, and I do care, because obviously China's market is really important in the global market, right? So we've got to. We do have to have a little bit of a foothold in China. I think the problem that we've had with China in the past, obviously, is that we don't know whether we can trust the data that comes out in China. So it's very difficult to see a data release from China and then go, okay, is that what's really going on? You used to have to wait for the Caxim reports and things like that to come out to get the actual real sort of independent data that came out. And so it's hard to know what's really going on.
Yeah,
I think if you've seen China at the moment, are they being very aggressive now because they are front running some weakness that they're seeing, in the market in the future as well? I think there's a little bit of an argument there, because if you look at other economies, they're like cutting because inflation's come down rather than necessarily over in the crapper, right?
Yeah, they're reacting,
So
not forecasting.
yeah. So it's an interesting situation to kind of look about. Obviously, the market had a very positive reaction yesterday. You saw the likes of Aussie and Kiwi have a really good reaction from it. I guess with the regards to that, you've got stimulus in China, and then you've got the back of RBA not going anywhere in terms of their rates. So there's it kind of fueled a lot of the risk on in the market, I felt yesterday. But whether it's sustained, I don't know. I feel like I've got to do a lot more analysis into that to have a real good feel of if that is a sustained move, and is it going to be something that we see is the change of the narrative now, and is that stimulus going to be the one that really drives sort of China's market back into action, I guess, because they've obviously been seeing a lot of downside in terms of their sort of performance. So you really need to see that flip, I guess, before you start really getting aggressive with growth in China. But is it a good floor at the moment? Maybe. Again, I think I've got to.
So you don't
really
care.
do.
Let's just cut
This
through
is
it.
short
Right?
way to say it. I don't care.
Okay, right, that's fair. Chat, let me know. Do you care? That's going to be a new segment. Do you care? We're going to come in and bring some macro news. Say, do you care? No. 9 times out of 10. Do you have a trade idea from this? No. Don't care. Throw it out.
Yeah. Do you care? Because you're the Australian resident. Do you care that this is going to?
Yeah. Chinese economy is very important to us because their biggest trade partner. If they're making money and spending and growing and whatnot, they're buying more resources. They're buying more Australian wine. They're buying more Australian meats. So yeah, we want their economy doing better. Absolutely, we do. But it is an interesting one that's unfolding. Speaking on the Aussie dollar while we are here, is to speak on CPI. Came out this morning, year over year, forecasted to come in at 2.7, down from I think it was 3.4. Someone correct me. It did actually hit on that 2.7. Core CPI is still high though. So core CPI, I believe, come in at around 3%, maybe 3.1. So it's still in that higher bracket, not where they want to be. Normal CPI or nominal CPI has come in into that 2.7. I don't think there's too much to read into. I think it was forecasted and everyone's quite happy the RBA didn't cut rates yesterday. They're like, yep, fair enough. This is still quite high. Obviously, media's jumped on the back of it and been like, oh my God, we're going down. Why is the RBA not cut? Blah, 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 blah. And, sometimes they've got elements to what they say that can be true. Other times it's just opinion and they want to get the click. And it's always fun to try and read through that mess when it comes to news and media. I did, however, find one thing interesting, and I've got a little chart to show everyone at home here that I got from from Reuters, actually. Reuters? How do you pronounce it?
I say Reuters.
Reuters. All right, let's go Reuters. This is the cuts, right? So the headline is obviously the Fed cut by 50 basis points, but I don't care about the headline. What I want to look into is the charts. This is pretty much the major economies around the world, at least in Western civilization, and where we're at when it comes to rates. And there's 2 things I want you to take away from this is the ones that are unchanged currently are Norway and Australia. Everything else has been cutting and have begun their cut cycle. Okay, now this chart alone can give you a good kind of broad idea on where it's pronounced Reuters. Oh, there you go. It can give you a good idea of where global economies are going and where you might be able to find some interesting interest rate differential. For example, if you look at the Japanese one here, it's hard to see. It's pretty flat with a couple of little upticks. So that's obviously going to start trending towards the upside, or that's what it's perceived to be doing. Whereas you look at something like Switzerland or even like Sweden, who are expected to cut rates again. I think it's even this afternoon, Sweden are expected to cut rates again. They're starting to really have that decline come through. And I just found this is an interesting chart that I was talking about interest rates, talking about CPI out of Australia, that I wanted to share everyone just to give you a kind of global perspective on where we are at with rates and what nations are moving forward with cutting and who are still holding. And the lines there, the color of the lines is really telling you that. But very much moving together. The US, I think the 50 basis, the best story I've heard with the 50 basis points is we should have cut in July, but we didn't. So we need to play catch up. And I love that. I love that.
Yeah.
That makes a lot of sense to me why the US went 50 basis points. We missed the chance to cut. Now we're going to play catch up. And I agree with it wholeheartedly. But any thoughts on that chart?
Yeah, I mean, the problem was the talk from the Fed was much different in July. It was way different. You know, they were talking about, you know, the sort of job market was resilient, and you know, back in July they were sort of happier where things were at, right? So yes, should they have cut in July? You know, probably. But again, is it like, you know, I don't know where inflation was in July. I don't know whether it was. I'm pretty sure it was still above the 3% mark back in July. So we kind of said maybe if it drops below that 3%, that's when they would start to really see the effects, because over a year period, or it might have been sort of 12 months at least, there was a year, 12 months is 12 months. I was going to say about 14, 15 months. It just kind of stayed between that sort of 3 to 3.4% level. Yeah. So once that finally cracked, I guess that was a real kind of confirmation for them that they could really kind of push those rates lower. Again, we're kind of trying to talk about the debate whether it's a celebratory cut or whether it's a oh crap, we're stuffed, we've got to cut kind of cut at the moment, cut but essentially like what every time we've seen them do this, it has led to a downturn. Well, not every time, but at least, you know, probabilities, you know.
In what?
Say again, sorry.
Downturn in what? It led to a downturn where?
Economically, in terms of recession, right? We usually see that there's like a recession followed a few months later. And I think the narrative from the Fed is so interesting, because I think Fed Chair Powell now just stumbles over what he says, because if you listen to what he says in a statement and then when he gets asked questions after, it's almost like he tries to back himself in question time, like, you know, and I guess everybody there who's asking questions, I feel like is vetted. The questions are probably vetted before they sit down, and, you know, no one's going to ask a very controversial question and things like that. I don't think it will feel like anyway. But, you know, he got asked in his statement before, he said that the labour market was sort of, I think he said it was coming under certain pressures, and that's why they've started to cut interest rates. I think they're expecting unemployment rate to rise to 4.4%. So that's nearing that 5% mark, where you're a bit like, well, you know, we don't want to get to that. But then when he was asked a question about it, he said, oh, no, the labour market is still strong. It's growing at a good pace. And then you're like, well, there's nothing clear about it anyway. You know what I mean? Yeah. So I just think it's you know, what is this type of cut? It's all about soft landing again or hard landing again. Everyone's in the soft landing camp, but where would you want to position yourself? You know, that's a difficult question, I feel.
Yeah, I mean, I've never seen a cut like this. I've been alive when cuts like this have happened, right? But I'm not in a position to say I saw it or I was with the knowledge that I have today. But when we have had these type of cuts in the past, it's not 50 basis points and we're done. It leads to many more cuts. And the only thing that really leads to more cuts is if you need stimulus. And I think that's the next question. that's the next question. I'm going to jump into freshly squeezed. I'm going to jump into what the charts are doing today. But just with what I've just said, I want you to keep it fresh in your mind, because I'm going to go straight from freshly squeezed here into what this chart is on my screen. Okay, I've had more fun with trading view charts, and I'm going to run you through. But before we do that, let's go ahead and get through all the prices. So I don't have the CFDs up, so I can only see how they closed yesterday. The S&P closed up 0.25% yesterday. The Nasdaq up 0.5%. Nvidia CEO has come out and said he's officially stopped selling the company. What I mean by that is his shares. He was offloading a lot of shares, banking in the billions of dollars. Why not go buy yourself some nice homes? What do you even do with $1 billion? Boats? Like that's just ridiculous amount of money.
Yeah,
but he's come out and said he's going to stop selling shares now. He's done. He's reinvesting back into the company. Investors like that. Investors want a CEO who's investing in the company. So we did see a large push up in Nvidia yesterday. Dow Jones closed up 0.2% as well, with the FTSE up 0.05% so far today. The VIX was actually down yesterday, down to the 15s. It looks like it's up a little bit, 2% at 1570 today. And the US dollar index is up 0.05%, sitting at around that 100.4. Coffee's up 1%. Oil's down 0.5%. Gold's down 0.1%. Silver's down 1%. Sugar still up 1%. 23.15 sugar is at. It's had a 23.6% run since we spoke about sugar, saying it's a great seasonal play. I'm about to tell you a little bit later on what my favorite seasonal play for 2024 is going to be. I don't know why I'm not picking that, because that is honestly one of the best trades out there. 23% in 2 weeks. Outstanding stuff by sugar. Aussie dollars down 0.2%, euros up 0.1%, pound down 0.2%, US dollar Japanese yen up 0.5%, US dollar CAD unchanged, US dollar Swiss franc up 0.13%, Bitcoin down 0.75%, and Ethereum down 1.2%. There's your quick run through on where prices are at and what assets are doing. Let's talk about this chart that I have on my screen here. And this is going back to what we've always talked about, the US 2-year yields plus the Fed funds rate. So this red line down the bottom here is the official Fed funds rate. It is delayed. We have dropped 50 basis points since this chart, and keep that in mind when looking at this chart. The blue lines, what we're seeing up the top here, are the Fed funds rate. So this minus the US 2-year yields. Now, there's a few things I want to have a look at. When we are at zero, where this yellow line is, that means we're at parity. The US 2-year yields are at the same price as what the Fed funds rate is. As you can see, this is where we bounce around. It's almost like looking at an RSI. Let's get into traders' terms. It's like looking at an RSI. The further we get away from that median, the more overbought or oversold it becomes, the more you want to bring it back into the median. Okay, and what you can see right now is where we are priced is the furthest we have been in a very, very long time. The chart's not updated. We have cut the rate by 50 basis points, which will bring this upper chart back into around those 1.3s, back into around here. But nevertheless, we did price up here, which is taller than what we had in 2008 and taller than what we had in 2000, both leading or preceding very large recessions, right? We are very, very out of the mean. I am looking to bring us in. The Fed cuts are going to be that thing that brings us in. Even with the 50 basis point cut, we still do not sit in a position where I am comfortable. I want to see this mean go back the other way, essentially. I want us to get around the zeros or back into the minuses before I start saying any kind of normality. The 2-year yields, what the market thinks. The Fed funds rate are reacting to what the market thinks. If the market thinks the Fed funds rate's at the right place, we'll be trading around zero. This will be around zero. We're not around zero. The market is thinking very different to what the Fed's thinking, and these two need to become aligned back around that zero. So we know what's happened in the past. Every time we've gotten really far out of these means, we are really far out of these means, and I think there's a visual representation of what these means look like and how to read them. It's just a little one that I wanted to give with Freshly Squeezed today.
I like this. I like when you have a little play around with these charts, because you get these really fascinating little insights.
I hope everyone else at home likes it. I know, because as soon as I start bringing up some of these funny charts, you start smiling, and I'm like, I pleased John today.
Yeah.
John's liking what I'm bringing, but I'm hoping everyone else at home. I don't hear when chat goes silent. We don't lose views, but they go silent. I've either overwhelmed them and their head scratching, thinking, "Let's wait until he says something actionable," or they're really engrossed in what I'm saying. And I'm hoping it's the really engrossed in what I'm saying and not the overwhelming. But I tried to break it down in a very simplistic manner, and I do that with my Australian accent by talking really fast, which probably confused people even more. But essentially, this chart for me just says that the Fed funds rate has a lot more to go when it comes to cuts.
Yeah, and charts like this are interesting though, aren't they? Because it makes you think like, sometimes a lot of the conversations we've had recently, I'm starting to feel like I'm a bit of a doomsdayer. I'm one of those people that are becoming like, oh yeah, there's going to be a recession, blah blah blah. That you used to see on Twitter every day. I was like, am I starting to become that person now? But when you start to put data behind it, and you're looking at sort of history, it's hard to use history because, in a way, history does repeat itself, but it doesn't necessarily repeat itself in the same way or in the same vein, right? So it's easy for us to sit here and pull these charts and go, look, this is what's happened in the past, but obviously we don't know what's coming up. We don't know, the magnitude of anything. We don't know if a recession is just going to be a very short recession like what we saw in previous recessions. So it's hard to say what's going to happen next, but I think what it does is open your eyes up to seeing, like for me personally, like seeing the exponential growth in like the S&P, and seeing the way the market is shaping up very similar to what we've seen in recessions in the past. It just makes me not want to go and invest in something like the S&P 500. It makes me want to go, okay, I'm going to sit back a little bit. I'm going to let this play out for a period of time, whether it be 5, 6, months, just see how this plays out.
Yeah, but Andrew's popped in and said, nah, I'm in a meeting and my network is poor. I'm usually behind a couple meetings. I'm not even going to ask, Andrew. I'm going to let you do your thing. John, let's do it. Let's move over. Let's get into the big bite. What do you have for us?
Let's do it. So I'm going to be talking today about gold, right? And I'm going to talk about the correlation between... I thought you froze then, George. Don't scare me like that. No, it's like, yeah. So we're going to be talking about gold. We're going to be talking about the correlation between gold and the US dollar index, because we've actually started to see the correlation come back, right? Which is interesting, because I think when you look at... So some of the top tips for gold really is, when you are trading gold on a day-to-day basis, is, you should go look at the dollar index because they're correlated. So if you see the US dollar index go up, you should be shorting gold. If you see vice versa, right? So a lot of retail investors just see the surface level of, okay, there's the correlation, I'm going to go trade the correlation. But correlations don't always last. We had a very weak period of correlation between sort of what I've marked up here is the 27th of March till the 17th of June. The correlation was weak, and it was weak because we saw them kind of moving very similar, right? We saw areas where the dollar index was rallying, so was gold rallying. And that comes down to, a number of factors. It could be down to sort of what's happening globally. In that period, obviously, we've seen a lot of sort of global stress in terms of wars and things like that. And the markets kind of run to safe havens. We saw a lot of buying of gold from central banks like India and China and whatnot. And that kind of gives gold this exponential growth, whereas the dollar index just kind of continued to sort of range. So there was a really weak correlation, and I think if you were trying to trade correlation at the time, it wouldn't have been very sort of profitable for you. Whereas now, we've started to see it come back. So we had a strong correlation period between April and March. We then followed it by a week. Now we've got a very, very strong correlation at the moment, which I think is very, very interesting to me, because obviously gold has had this exponential growth, dollar has fallen off a cliff. But what's interesting in terms of if that correlation sort of remains, for me anyway, is if we do start to see a shift from gold and from the US dollar index, right? So if I try and bring up the gold chart. This is gold prices as of half an hour ago. I've had to screenshot it, so I don't know where gold prices are sitting right now. But you can see this growth here.
They're trading at 2,000.
Exactly. But we're in this kind of nice little uptrend at the moment. I'm just kind of monitoring this at the moment because I'm looking for potential breaks lower because of what's going on in the commitment to trade report. So we've been talking about, I feel like I've been talking about this every week on gold. Like we've been looking at the commitment to trade reports and I've been going, yeah, there's, potential indications of a market top, but I need to see X, Y, and Z happen first. And I'm still kind of in that same camp. And I just want to, again, I'm showing you these charts because I want you to be open-minded to the fact that you don't just want to go and rush into a market because it's going higher, right? You don't just want to buy into it because it's bullish, essentially. And I'm looking at the commitment to trade reports. And one thing that I've noticed from last week is the fact that the non-commercial, so the hedge funds, are now buying at levels that have surpassed that of March 2022, right? Which March 2022, we saw a move down from $2,000 to around about $1,600. The only difference between this time and the previous time is that the non-commercials are not shorting at levels that we've seen prior. So that just makes me think that maybe we're going to get a short-term top again. We talked about this a few weeks ago where we saw this little kind of pullback on the weekly chart. There was a minor sort of pullback, which was a short-term top. And I feel like we're in that kind of same bracket. So for me, I feel like gold has got this interesting sort of narrative at the moment that it's just driving higher. But there will be a point where it's going to come to an end. I think the end's going to be where the commercials in the market reach levels of shorting that they haven't done for a very long time, that be it above sort of 450,000 contracts short. And then I think from the hedge fund side of things, if they continue to buy aggressively into this rally, then I think that's going to cause that sort of extremes that we've seen previously in the past where we see those big reversals. So for now, am I buying into gold? Absolutely not. I think this is at levels where I don't want to get involved with it. I don't see the value in being in gold right now. I think if we get, well, what I'm kind of thinking is we're going to get a short-term top in the market. We're going to get another pullback. I think we're then going to see another rally, and then I'm going to wait for short contracts from the commercials to be aggressive, and then we're going to see some big changes. Say again?
Are you going to short?
I will short if we see kind of a technical change here. Now, this is a 4-hour chart, right? So it's not something I'm looking for a long-term move. I think if we break this channel, break 2640s, and then we kind of fail to break back above the 2640 level, I'll be happy to get short down towards the 2600s on a very short-term play, maybe even down to the 2580s. But I think it ultimately, for me to look for a larger reversal in the market, I need to wait for the the commercials to be at aggressive shorts. But the interesting thing about this and the correlation between the US dollar index as well is that the dollar index is approaching significant lows. And I haven't brought the COT report on the US dollar index at the moment, but you should see the levels that they are reducing their sort of long positions. Yeah, it's actually quite aggressive. So
I like it. I'm gonna we've got a quick minute here, and I'm just gonna change it up a little bit. I've got a seasonal play, which could be one of the best of 2024, and it's gonna throw people completely off. John, seasonal plays so far this year, we haven't been overly great at. Solely because seasonals in FX this year haven't, at least over the past 6 months, haven't been something you want to live by. We've had too much changing in the macro. Seasonal things have been all over. But where we have hit the nail on the head time and time and time again this year is when we look at seasonals in equities. We've got a fantastic hit rate. I'm going off the cuff here, but I'm going to say we haven't picked one wrong when it comes to equities, when it comes to seasonal plays. So I'm going to challenge it again. And I'm going to bring an equity for everyone. You may have heard of the SIBO exchange. All right. it is an exchange. It is like the New York Stock Exchange, for example. It is a public company. They do futures, they do options. You know where your CFDs are based off of? There's a very good chance that your currency CFDs are based from the CBOE Futures Exchange. And it's all completely a public company, something you can trade. It was listed about 14 years ago. And I've got something to share with everyone because from about 14 years ago, without failure, every year since it's been listed, we have seen a gain between the beginning of October and the end of November. That's a gain with an average return of 10% in CBOE Global Markets Incorporated. And to have a look at this, I mean, 2010, we got up to 20%. We had a couple low years in 2011 and 2012. I say low years are still about 2.5%. And you can see we've had this great trend over the past 3 years. 2021 in at 5, 2022 up at around 9, 2023 up at around 13%. We do still get a bit of drawdown. The max drawdown we did see is in and around 10% in 2020. Completely recovered that drawdown by the time we finished the month with 8.3% profit. So there's not much to look to on the downside, not too much data. 14 years of history here looking at CBOE markets, 100% win rate over those 14 years with an average return of 9.71%. If you wanted to be really cautious and throw in the stop loss in and around that 10% of what we did do in 2020, good news, you're still trading a risk to reward ratio of 1. Fantastic trade idea here on CBOE high side into early December. Guys, I'm going to let me know what you think of this in the comments. We have gone over time. I'm going to send you over to Rich and Will on their channel on the London Live Trading floor. John will be back tomorrow morning. Tomorrow morning, market wake up, 8:30 a.m. British Standard Time. Take care. Have a fantastic day, and we'll see you all soon.
See you soon.